Welcome, dear viewers. Dr. Vijay on accounting, lecture number 3. Useful for all those who wants to learn accounting through self-study. PowerPoint slides are used. Thank you for participating till the end with total involvement and attention. Let us go to slide 1. Let us take slide 1. In double entry bookkeeping, every transaction is posted in the ledger in two places, in the debit side of one account and on the credit side of another account. We have seen that in last slide of lecture 1. A purchase of goods for cash is to be posted in the debit side of purchase account and on the credit side of cash account. Now the question is, how is the debit and credit aspects of each transaction decided? How is it decided that purchase account is to be debited and cash account to be credited? Let us go to slide 2. That is the last slide of lecture 1, which you have seen already. We are looking at it once again to make things clear. See slide 2. This we have seen in the previous lecture, slide 7. A purchase of goods by A from B for instant cash payment of $1,000. It is recorded in the debit side of purchase account and the credit side of cash account. In the purchase account debit side, it is shown as to cash. In the credit side of cash account, shown as by purchases. That is, in the account in which it is debited, the name of the account which is credited is shown, and the account which is credited, the name of the account which is debited is shown. In the account in which it is debited, shown as to cash account, that starts with the prefix to. On the account which is credited, shown as by purchase account, starts with the prefix by. Okay, this is how ledger posting is done. Please read slide 3. There are two approaches for deciding the debit aspect and credit aspect of transactions: golden rules and balance sheet approach. Now we are studying golden rules. There are 3 golden rules for 3 categories of accounts. 1 for real accounts, 2 for nominal accounts, 3 for personal accounts. The various accounts in the ledger book can be classified into 3 categories: real accounts, nominal accounts and personal accounts. First category is real accounts. Accounts in the names of assets and properties like cash, furniture and fittings, land and buildings, patents and trademarks, etc. etc. The rule is debit what comes in and credit what goes out. Take cash account. It is an asset account, where through a transaction cash comes to the firm, debit cash account. Where cash goes out through a transaction, credit cash account. Where purchase goods for cash, cash goes out, so credit cash account. Where sold goods for cash, cash comes in, so debit cash account. Now the second category is nominal accounts. Accounts in the names of expenditures and losses and incomes and gains of revenue nature. Every firm has a number of items of expenditures and losses and incomes and gains. For a trading firm, the major item of expenditure is purchases and major item of income is sales. Besides purchases, it will have a number of expenditures: salaries to employees, wages, rent, water charges, electric charges, so many expenditures. Like that, there will be so many incomes other than sales, as interest income, commission received, etc. For all expenditures, whenever the expenditure is incurred, debit in the concerned expenditure account. Where goods are purchased, debit purchase account. Where salaries is paid, debit salaries account. Where goods are sold, credit sales account. Where commission is received, credit commission account. Now, the third category is personal accounts. A firm keeps personal accounts in the names of parties with whom it has credit dealings. When you are purchasing goods on credit, then you should have an account, the name of that party to whom you have sold. When you are purchasing when you are taking a loan from a bank, you have to have a personal account in the name of that bank. You call it as a loan from such and such bank, etc. Now, when you are selling goods on credit to a party, you should have personal account in the name of that party. For personal accounts, the rule is debit the receiver and credit the giver. You have to look upon from the angle of that party. When you are purchasing goods from M on credit, M is giving you goods. M is the giver. So M's account should be credited. We know when purchase goods on credit, purchase account is to be debited. So purchase account is to be debited, and as M is giver, M's account is to be credited. Where you are selling goods to N, you know sales account is to be credited because sales is income. N is the receiver. You are selling goods to him. He is not paying cash, so he is a receiver. N's account is to be debited. When you are taking a loan from N or say Z, Z is the giver, so give credit to Z account. When you are repaying a loan to Z, Z is receiver, so Z account is to be debited. For personal accounts, there is a sub rule. To show that a party owes something to you, to show that M owes you $1,000, M's account should be debited. To show that you owe something to a party, the party's account should be credited. To show that you owe 1,000 rupees to Z account should be credited. Okay, let us see more about these rules in slide 4. Golden rules is explained in a more simple way. For asset accounts, if the asset comes in, debit the asset account. Example, when rent is received in cash, cash comes in, so debit cash account. If the asset goes out, credit the asset account. When cash is paid as wages, credit the cash account. We know wages being expenditure, wages account has to be debited. For nominal accounts, if it is expenditure or loss, the account is to be debited. Debit the expenditure loss account. Example, rent paid to be debited in rent account, purchase of goods to be debited in purchase account, wages paid to be debited in wages account. While receiving an income or gain, credit the income or gain account. Example, sales, when goods are sold is income, so credit sales account. Where commission is received, it is income, so credit commission received account. For personal accounts, where the firm is giving some to a party, debit the party to whom it is given, because party is receiver. Cash given to M, debit M's account. We are getting something from a party, the party is giver, credit that party's account. If cash is received from N, a customer, credit N's account. So, on the whole, it is very simple to remember. Where you are thinking of an asset, considering an asset, if the asset comes in, debit the asset account. If the asset goes out, credit the asset account. While incurring an expenditure, debit the expenditure account. While earning an income, credit the income account. While you are giving some to a party, where a party is receiver, debit that party's account. Where a party is giver, credit that party's account. Okay, let us proceed to next slide. Slide 5, 6 and 7 is an illustration. Illustration number 1. At present we are doing slide 5. So it is part of the illustration. Please read it very carefully. Sabu inherited a trading firm which was run by his father on the first week of January 2020. The firm had cash in hand $6,000, balance at bank $12,000, stock of goods in trade $36,000, due from Miranda $22,000, and furniture and fittings valued $8,000 as on the time of inheritance. So these are all assets. Look at that. Cash. The time of inheritance, in the cash box of firm there was $6,000. At the bank account there was $12,000. Stock of goods for sale $36,000 was there. 22,000 rupees was due from one customer, Miranda. Furniture and fittings of the value of $8,000 was there. These are all assets. Now continue. And had to pay rent of the shop building for 3 months $9,000, due to Raj and Company $15,000 for goods supplied, and a loan due to Azad Bank $14,000. These are all liabilities. Rent was due for 3 months $9,000. $15,000 was payable to Raj and Company for supply of goods, and a loan was due to Azad Bank, 14,000 rupees still payable. These are all liabilities. So, assets and liabilities of Sabu's firm at the time of inheritance on the first week of January 2020 is given. Okay, now the next slide, slide 6 is a continuation of this. That is the transactions that has taken place at the firm during the first week. We are taking slide 6. Slide 6 is continuation of the illustration. The transactions at Sabu's firm during the first week after inheritance. January 6, goods supplied by Joji Traders, $42,000. Joji Traders has supplied to Sabu's firm goods of the value of $40,000. That means Sabu's firm has purchased the goods on credit. Wherever in transactions of buying and selling, if the name of the party from whom bought or to whom sold is specified, it should be understood as a credit transaction, unless it is clearly stated as a cash transaction. Here the name Joji Traders is given, and nothing is mentioned about whether cash is paid or not. So it should be understood as a credit transaction. So it should be shown in purchases account and Joji Traders account. If it was purchase for cash, it should come in purchase account and cash account. Here it should come in purchase account and Joji Traders account. Purchase account is nominal account expenditure to be debited. Joji Traders is personal. Joji Traders is giver, so should be credited. Coming to transaction number 2, which takes place on January 6 itself, sold goods to Rollins on credit. So, sales account is one account, the other account is Rollins account. We know sales is income, so sales account to be credited. Rollins is receiver, so Rollins account to be debited. Now, Jan 7, sold goods for cash $70,000, received through account to account transfer. Here again, sales account and cash account. Sales is income, so sales account to be credited. Cash comes in, not to till, but to the bank account. Cash comes to bank account. Bank account is receiver, so bank account to be debited. Drew from bank for cash. So cash is taken from the bank for cash. Cash comes to till of the firm. So cash account, cash comes in. Cash account to be debited. Bank account is giver, so bank account to be credited. Wages paid for unloading goods purchase. cash goes out of the firm. So cash account to be credited. Wages is an expenditure, nominal account, so wages are going to be debited. Now Jan 10 paid salary to salesman by check. Salary is an expenditure of the firm, so salary account to be debited. And it is paid by check, so money goes out of the bank account. Bank account is given to be credited. Now Jan 11, purchase furniture and fittings for $15,000 from Mada Interiors. This is purchases, but not purchase of goods, so you can't show in purchase account. Only purchase of goods for sale you can show in purchase account. This has to be shown in furniture and fittings account. It comes in, so furniture and fittings to be debited. Mada Interiors is giver. This is again a credit transaction, you are not paying cash. Mada Interiors is giver, so Mada Interiors account to be credited. Okay, let us go to slide 7, which is again continuation of the same illustration. I am not explaining the details of slide 7. In this session, we are considering only the journal entries to be made for the transactions given in slide 6, this slide. So slide 8 will be the journal entries for transactions given in slide 8. Anyhow, as a part of the question, we are considering slide 7, that is transactions that took place after Jan 11. Let us see slide 7. Slide 7 is again continuation of illustration 1. Here we are reading some transactions that took place after January 11. We are not going to the details of that and not considering debit aspect and credit aspect of the transactions, because some further explanation is needed for coming to understand that. Let us see. January 12, Sabu has taken goods of the value of $500 for domestic use. On January 12, Sabu has introduced additional capital in cash, $20,000, and has drawn $1,200 for his personal purpose from the bank. On Jan 12, firm returned goods of the value of $700 to Joji traders. On Jan 13, Rollins has returned goods of the value of $900. On Jan 14, the firm settles the account with Mada Interiors, remitting $14,500 through account-to-account transfer. Mada Interiors agrees to forego $500. We are earning a discount of $500. And Jan 14, Rollins, from whom the firm has to get $19,300 for goods sold, gives $19,000 in cash, and the firm treats his account as settled. That means Rollins gains a discount of $300 and we are losing it. For us it is discount allowed. Okay, now let us go to slide 8. Slide 8, we are seeing the journal entries. How the transactions given in slide 6 are to be recorded in the journal book. Only that. We are not considering slide 1 or slide 7, because slide 1 and slide 7 needs more further explanation. We will study in lecture number 3. With slide 8, this lecture ends. We are considering only the journal entries for transactions given in slide 6. Let us go to slide 8. In slide 8, we are seeing how to record transactions in the journal book. We know transactions are at first recorded in journal book, and from there it is posted to the accounts in the ledger. How to record transactions in journal book, that we are studying for the first time in this lecture. See, this is the form of journal. Now we are studying how to record all transactions in single journal book. Single journal book. This is the format of journal book. Date column, particulars column, ledger folio column, debit column, credit column. Debit column, credit column for showing amount. See how the first transaction given in slide 6, how the transaction is recorded in the general journal. We know purchase of goods from Joji Traders for $42,000. That is a transaction. See how it is recorded. Always the account to be debited is shown first. In that transaction, purchases account is to be debited. We have seen because purchase is expenditure. Joji Traders is to be credited because Joji Traders is giver of the goods. It was a credit purchase. So look how it is shown. Purchase account debtor, DR. It is to be read as debtor. Purchase account debtor to Joji Traders. To Joji Traders in second line. This is a format of a journal entry. You have to show the account to be debited first. Against that, show the symbol DR. And next line, to Joji Traders. Somewhat indented. Right, somewhat indented. Okay. In the amount column, in debit side, debit column you have to show 42,000 against the account to be debited. In the credit column you have to show the amount for 2,000 against the account to be credited. That is against Joji Traders. This is a format in which journal entry is to be given. Now below that in bracket you can explain the transaction. Here it is shown goods operated on credit. You can give it in brief. This is called as narration. Narration is meant for bringing out or disclosing whatever cannot be revealed through the format of the journal entry. The format of journal entry is very specific. You show only the name of the account to be debited and name of account to be credited. If you want to disclose any other information through the journal entry, that you have to show in the narration. So now let us see the other journal entries. The second one, that also on Jan 6, roll-ins debtor to sales. Sold goods to roll-ins on credit, that transaction of Jan 6. Roll-ins debtor 20,200 to sales 20,200. So roll-ins account debited, sales account credited. Goods sold on credit. We are giving just brief narration. Now Jan 7, cash drawn from bank for office use. No, sorry, Jan 7, goods sold for cash, money received through account to account transfer. So it is a sale, so sales account to be credited. Money comes to our bank account through account to account transfer, so our bank account is receiver. For personal accounts, the rule is debit and receiver. Sales is income, so to be credited. So bank account debtor to sales. Next is cash drawn from bank for the business cash, business use. So cash comes in, so cash account to be debited. For real account, debitor comes in. Now, bank is the giver. Money comes from bank. Bank is the giver, so bank account to be credited. So cash account debtor to bank account. Next transaction, wages paid for head road workers. Wages is an expenditure, nominal account to be debited. Cash goes out, so cash account to be credited. So wages account debtor to cash. Next, on Jan 10, salaries account debtor to bank. Salaries given to salesman by check. So money goes out of bank account, not from cash. Salary is expenditure, nominal account debited. Bank account to be credited because bank is giver. Now last transaction, furniture and fittings account debtor to Mother Interiors. Furniture and fittings account to be debited because furniture and fittings comes in, new furniture is bought, comes in, debit, real account. Mother Interiors is giver. This transaction is on credit, we are not paying now. Journal entries for transactions in slide 6 are only considered in this slide 8. The rest of the answer to this illustration we will learn lecture 3, because answering slide 5 and slide 7 needs further theoretical explanation. Thanks for your participation till the end. Please subscribe and click bell button for viewing further lectures. Like and share to your friends and relatives. Thank you.